All right, so the topic of how much risk you should take is a common topic when it comes to the concept of investing, and I'm going to weigh in on my opinion. Now, again, I would preface it with this is just my opinion, right? Not a professional by any means. Do your own due diligence, right? So again, I said the proper amount of risk you should take when investing is just before the point where you lose sleep over it, right? And honestly, I've never heard anyone put it that way, which is why part of the reason why I wanted to talk about it. But I think that that's the perfect amount. Right before that point to where you start to lose sleep, right? If you're losing sleep or it's causing you excess stress, then you're probably taking too much risk. Now, another important thing here is I think a lot of people don't understand risk as well, is in that they see the stock market go down, whatever, 10 or 20%, and they think they're going to lose all their money, right? And technically, that's only a bad thing if you need that money right now, right? Now, again, if you're properly situated, that's not a concern for you, right? That's not a concern, right? So if you see the stock market go down and you're super concerned, either you were doing something really stupid in the first place, or you're not doing something stupid and you just don't understand the stock market in general and risk, right? The traditional rule of thumb is in the inverse of your age should be in stocks, and obviously the opposite of that in bonds, right? And I don't think that that's terrible. I think that that's a decent way to start, but I would critique that and say, if you're under 40 for sure, probably even 50, I don't know why you would want any money in bonds, right? Because, I mean, part of the reason why bonds have, that line of thinking has worked is bonds have been in a bull market for whatever, 30 or 40 years, right? Now, again, now technically you can get, crazy good, not crazy good, but decent returns on short-term bonds, right? On, even money markets and stuff like that, right? So I think that that's partially true, but the problem with bonds is that no one knows where rates are going to be in a year, let alone 10 years from now, right? I mean, if they're a lot lower, then chances are stocks do very good. If they're higher, well, chances like the existing funds are going to do bad. So in my opinion, you should be definitely overexposed to equities when you're younger, right? I mean, and this again, just my opinion, I think people don't take nearly enough risk when they're younger, like nearly enough. And another really big problem is if they do take risk, a lot of times they take it in a stupid way, right? And that brings me to crypto, right? Crypto is very much misunderstood, right? Especially by the existing, financial kind of people, right? Because the first mistake a lot of people make is that they lump crypto all together. It's all the same. When in reality, it couldn't be any further from the truth. Because you have a lot of these pump and dump, which again, honestly is most coins, these pump and dump schemes. And then you have Bitcoin. Right? The crypto space is Bitcoin, and then there's everything else. I think that you could make the argument that there's a handful of other half-decent coins, but it's Bitcoin and everything else. Right? So again, I think that people are absolutely crazy for not having some exposure to Bitcoin, even if it's like 1%. Right? If you don't have 1%, I would say more, in my opinion, but if you don't have 1% exposed to Bitcoin, I think that the risk is way higher not to have the exposure, right? And people say, oh, well, it doesn't have any value. Well, it's like, yeah, people who make that argument, you're confessing you don't understand what you're talking about. If you understood what you were talking about, you would take the steelman argument and go against that. Whenever people say Bitcoin doesn't have any value, or they lump crypto all together, they're confessing they don't know what they're talking about and they haven't done their due diligence. Doesn't necessarily prove 100% for sure they're wrong, but it definitely proves they haven't done their due diligence, because the use case for Bitcoin is the government can't censor you, the money cannot be censored, you can send it cheaply, you can take it with you wherever you want with virtually no chance of it not working out, Can't do that with gold. You can't do that with your bank account. You can't do that with your stocks. Can't do that with your real estate. So Bitcoin has two, and it can't be debased. Right? So Bitcoin has many aspects to it that do not exist in any other financial asset, including gold, silver, and those kind of ones. Right? I can take my Bitcoin across the border without anyone knowing. My Bitcoin will always be mine. It cannot be taken. I mean, technically someone could put a gun to your head, but it cannot be taken, it cannot be debased, and it cannot be censored. Right? Those are the big selling points. There's other things as well, but those are the big selling points. Right? And the fact that people don't, if you're going to be anti-Bitcoin, you at least need to address those points. If they don't address those points, in my opinion, you should be dismissed. Right? But again, back to the main point here. The point I was trying to make is people, a lot of times when they take risks, they take it in a stupid way, right? I seen a post the other day that showed that a lot of these NFTs are down like 95%. It just in a matter of like a year or two, right? I think Justin Bieber it was, don't quote me on it, but he bought one for like $1 million and it's worth 50 grand now, right? So again, that's a way that people take risk in a stupid way, right? Because from what I've seen, NFTs have no value. Theoretically, a little bit, but compared to Bitcoin, yeah, they're useless, right? A lot of these pump and dump coins, they have no value, right? They have no value. They're glorified unregistered securities. So anyway, to sum it up, I think that people should be taking more risk, but you need to take it in a smart way, right? Another common mistake that I think people are making, again, just my opinion here, is people are overexposed to a lot of these large cap companies like your Googles and Facebooks and Amazon, Nvidia. And the reason for that is, I mean, if you take Apple, they would need to become like a 20 or a 30 trillion dollar company to 10x. Right? Now, again, how easy is it for a company to go from $1 billion to 10 billion? Or even 10 billion to 100 billion? Like, $1 billion to 10 billion happens all the time. Right? Happens all the time. But it will probably take a decade before we see a 20 or a 30 trillion dollar company. Right? So I think that people are overexposed to those. Now again, the problem with small caps is they are risky and that a lot of them are going to go out of business. Apple, the chances of them going out of business is very low. Right? So again, I think you need to be very tactical in the way you do it. You need to identify those really good opportunities. And when you filter out the companies that are losing money, that are, they're unprofitable, the management they're basically paying themselves crazy amounts of money through stock compensation, those kinds of red flags, right? If you can avoid those companies and find the ones that truly are changing the world, right? I mean, a lot of these smaller cap companies too, they don't even need to be the next Amazon or Apple. Right? Like I said, to go from $1 billion to 10 billion, you don't need to be the next Apple. You don't even need to be that big of a company. You don't even need to be a company that the vast majority of people have heard of. So I think that that's another very important point for people to understand. So anyway, that's just my 2 cents. If you liked the video, hit that like and subscribe, comment, all that good stuff. Thank you.